It's time now for On the Radar, when we ask an investing professional what they're looking at in today's markets. The price of gold is in focus. Let's bring up a one-year view of the price of gold. And you can see it's more or less flatlined since March or so. But Brianne, that is a better picture than we've seen in equity markets. And so you have been adding gold to client portfolios. Tell us about that.
Yeah, we've seen kind of gold year to date, to the end of October, kind of outperform the S&P 500. Gold up over 9%, S&P up around 8.5. So even in that recent rally you saw, we have been adding gold to our client portfolios kind of in the middle of October. And we have always had a position sometimes this year. Sometimes we have been underweight or overweight, but we saw a great opportunity, saw the sector, thought some momentum was going to be coming, especially with the uncertainty in the economy. It's a great asset that people flee to safety, especially in the U.S. And also, the geopolitical concerns with a war. So it's a great inflation hedge as well, with inflation still being a little bit sticky. So for us, we did add, we're up about 5% already since adding in October, but we still see some upside in the gold space.
What do you expect gold to do in client portfolios? Hold value or actually increase in value?
Obviously, the timing we added this recently, taking this little bit of uptick, we are happy about that. You're seeing spot over 2K. If it can hold around these levels and continue to go higher, we could see a little bit of outbreak in gold, or you might see it consolidate around that 2,000. But for us, we do want it a little bit of both, right? So we want it to be an inflation hedge, a cyclical hedge, and also act as an uncorrelated kind of asset class into the portfolio as an alternative for us. But also, if we can make a little bit too, when the markets are pulling back and gold is going up, that's a great value-added bonus that we can offer to our clients.
What vehicles do you use to gain gold exposure?
Yeah, so for us, we use the bullion. We buy GLD, the ETF, and also Vault VALT as our way to get exposure. We find that's a great cost-effective solution, actively can trade it, and fully liquid on the market.
You provided us with a table of data, and we may have a summary of that data now, showing the performance of gold and silver during periods of major declines on the S&P 500. And there's the average. There are about 8 or 9 individual market crashes from 1978 through to 2020, detailed in the graph. And then at the bottom, we see these figures. So the average decline during one of those market crashes was about 30%. Gold, on average, rallied by 6.5% during those market crashes, and silver contracted on average during those periods, but only by about half as much as the equity market did. So that's that lack of correlation, that counter correlation that you're talking about, correct?
Yeah, exactly. During any kind of stock market sell-offs or crashes, we do tend to see gold outperform, and as you saw, by an average of 6.5%. Also, why we have ramped up our allocation a little bit. Gold actually outperformed the S&P 500 as well. You saw it last year in 2022 when the market had a nice sell-off. Even coming out of COVID too in 2020, gold actually outperformed. So there are periods of opportunity. We're not gold bugs where we think gold is the end-all be-all. But if we can tactically play it, if we can use it as a cyclical play and inflation hedge, and also during times of uncertainty, we think there is potential upside in that space still.
Well, last question. You prefer ETF exposure that gives your clients exposure to gold bullion, the metal. Why not shares of gold mining companies?
Yeah, so I think we still potentially like the miners. Just right now, I think there's a lot of risk to the miners. It depends if they hit gold and, are able to find some. I think for us right now, we just want to be in quality across the board, whether that's in the ETFs and the gold or stocks that we're invested in. It's all about quality this year. I think, potentially headed out of a recession into a recovery, we might look at switching to the miners. I just think there's too much risk right now.